Hello friends, so far we have discussed the majority of the balance sheet items. We initially started with current assets and we discussed what are cash and accounts receivables, inventories, and we also looked at other current assets like prepaid expenses. Then we had looked at the current liabilities like notes payable, short-term debt, accounts payable, accrued liabilities, etc. Thereafter, we went to the long-term assets, looked at what could be the long-term assets, plant and equipment. Then we had also discussed about goodwill here, so and intangible assets. So a lot of discussion was done here. Now we also covered some of the items on the long-term liabilities side, especially on the debt, where long-term debt can be raised by the company in order to fund the projects that they are deploying. So one item which is still left when we are looking at the balance sheet is basically the shareholders equity section, and from the point of view of shareholders, in fact this is the most important section. So let us now look at what shareholders equity actually mean. Now before we proceed and discuss about shareholders equity, let's revisit the balance sheet again. On the asset and the liabilities side, assets, we had defined earlier that these are basically nothing but resources of the firm. So resources could be cash or accounts receivables or property, plant and equipment, goodwill. These are all resources of the firm. And on the liabilities side, basically this provides us with the way this resources have been funded. So all the funded of the resources is provided on the liabilities side. So if you look at the measures of funding, what we have learned till now is that funding can come from two ways. One, which we have actually looked at, this is through the debt capital. So why does company require funding? Company requires funding in order to grow, so that they can invest the funds in the business and generate higher returns. So one way was the debt capital, and if the company opts for debt, what they are actually committing themselves is that they need to pay interest to the debt holders at regular interval, and they will also have to repay the principal amount. But what is happening here at once is that they are not taking any ownership of the firm. So there's no discussion about the ownership of the firm when we are looking at the debt capital. Now there can be another way in which the company can fund itself. The second way is through the equity capital. Now equity capital is all about investing and taking ownership in the firm. So if you're talking about ownership in the firm, the company is not liable to pay interest, so they don't pay interest. They don't have to pay principal, obviously, but what they actually get is something like dividends. Dividends are nothing but a share out of the profit, and what they also get is a share upside or downside. So I'll discuss each of them one by one: share upside, share downside, and dividends. However, please note again that company can fund itself in two ways. One is debt, and these guys don't take in ownership in the firm, and if that is the way it is, they have to pay interest and principal. However, when you are looking at equity funding, the ownership of the firm is being shared with the investor, and they don't now have to pay any interest or principal. However, they will be liable to look at the dividends, and the investors also have to share the upside or the downside of the share trading. So let's look at the equity ownership further when the company wants to raise capital through this measure. Now let us assume that there's a company A that wants to raise capital to an extent of, let's say, $1,000. Okay, we're just taking some arbitrary numbers here. The company wants to raise $1,000 so that they can start the business operations. So as we have discussed earlier, there are two approaches to raising funds. One being the debt capital, and the second one is basically the equity capital. Now let's assume that this company has raised $600 from the debt capital, so that the remaining $400 is basically raised using the equity capital measure. Now as we have discussed earlier, this equity capital measure is basically representing the ownership of the firm. So what this means essentially is that 100% of the ownership has been parted away by raising $400. Now let's introduce ourselves to some of the terminologies associated with this equity capital. There are terms like shares. Then these shares can be divided into two types: common shares and then preferred shares. So we'll discuss and take each one of them one by one. So let's start with common shares. We had earlier noted that 100% of the ownership was all about $400 being raised for the company. So let's assume that arbitrarily that the company had 100 shares which are common shares. Okay, 100 shares of common shares have raised $400. So what is per share value? Per share value will be equal to $4. Okay, here there is another important thing that you must note. There's something called par value, and the second thing which is known as the additional paid in capital. There's a par value and then there is an additional paid in capital. So let's assume that if the par value was 1, I'll come to what par value actually means. Then an amount over and above $1 would be $3 here. So what we are saying is that this $4 is divided into two parts. One, there's a par value. The par value has been defined as 1. So the additional amount over and above the par value would be $3.